U.S. household debt, a new alarming milestone. I'm Bob Stokes with Elliott Wave International. At least since Prechter's Conquer the Crash first published in 2002, we've been sounding the alarm about the unsustainable rise in debt. The book quoted a February 1957 letter written by bank credit and Elliott Wave expert Hamilton Bolton. In reading a history of major depressions in the U.S. from 1830 on, I was impressed that all were set off by a deflation of excess credit. This was the one factor in common. Here are 4 charts and commentary from Conquer the Crash. These charts show some aspects of both the amazing growth in credit, as much as 100-fold since 1949, and the astonishing extent of indebtedness today among corporations, governments, and the public. So the 2007-2009 financial crisis came as no surprise to us, as exotic financial instruments like collateralized debt obligations imploded. Now, in 2017, U.S. debt is approaching a new milestone level. The Federal Reserve just issued a quarterly report and says the increase in 2016 amounted to $460 billion, the biggest leap in a decade. At the current rate of growth, household debt is expected to break the 2008 record high of $12.68 trillion sometime in 2017. Mortgages still make up the bulk of household debt, but student loans are now 10% of the total. Auto loans are 9% of the total, and credit card debt is 6%. Dollar amounts rose in each category in 2016's fourth quarter. Indeed, here's a February 17th Bloomberg headline. Student debt in America has hit a new record. As the article notes, U.S. student debt hit a record $1.31 trillion in 2016, the 18th consecutive year it's risen. Let's now turn our attention to the U.S. automobile market, where car makers have been luring in buyers with rebates and generous longer-term borrowing terms. Review this chart from our February 2017 Elliott Wave Financial Forecast. Here's the commentary. As of September 2016, total subprime loans were $172 billion, or 16% of the $1.1 trillion car loan market. The chart shows a record $30 billion jump in the third quarter. In another unmistakable sign of a stretched-out credit bubble, J.D. Power estimates that 31.3% of car buyers through auto finance companies were upside down on their existing loans. We believe that the current growth rate of U.S. debt matters, just like it did before the 2007-2009 financial crisis, and just like it did before the deflationary depression of 1929-1933. We will continue to share vital information with our subscribers about the unfolding story of rising debt. Get more financial insights like these, absolutely free. The link on screen gets you started.